Hey traders, welcome to Charts and Coffee. Hope everyone is having a great Wednesday morning. We are going to take a look at what we're dealing with in this continued very high volatility chop. If you haven't checked out the video yesterday at the Simpler Trading YouTube channel, and I had a big long discussion with the Trish boss, and those of you in the Sector Secrets Mastery know who she is. And those of you that have just taken the top tier pro class, of course, know who she is. And one of the things we talked a lot about is the struggle. And we kind of shared some stories of different points in time. She's been with me for over a decade of different times of struggle, whether that be in trading or not. And look, gang, the best thing we can always do is acknowledge one of two things. If you're out there and you've been trading for a long time, like I have, you've seen variations of about every kind of market out there. And we just have to remember that we traveled through them before. It reminded me of, y'all ever hear that story about the bison? And if a big storm comes in, a big storm, snowstorm, and they actually walk into the storm because nature instinct has taught them that's the quickest way out. Well, for us as traders, we have to look exactly at what we've got that we're dealing with, not what we wish we had, not where we wish we were, not that, oh gosh, Q1 was so great. No, we're in Q2. This is what it is. So in order to kind of walk into that storm, we remember, we probably dealt with challenging markets before. And if you haven't, find someone who has. Find someone who's been, I've been there before. And this is how we dealt with it. And that's kind of what we started with that video yesterday. So please do check it out. It will at least define for you what is happening right now in terms of the increase in volatility. When did it kick off? Has this been going on for a while? By the way, not really. And if it feels like it's unusual, it really is. And this is something I can tell you from 30 plus years, but every challenging time has a shade of something we've already seen. There's a measuring stick that we've already created based on other tough times. And this is how we measure and say, okay, this is what we need for things to be normal again. This is why it happened. This is even more precisely when it happened. So you're not arbitrarily going back over many, many trades saying, oh, this was because of this. No, you can actually look at the date. And that's what I did in that video. Said, this is when this happened. This is when that happened. And this is what we're looking for things to kind of get back to some sort of normalcy. And today might be a good, what I'm seeing on the VIX here might be a really good start for what we want to see. Let's get back down to levels. And once you watch the video, you'll know what I mean. Let's get back down to levels where price action becomes something less, bananas and back to zones. Doesn't have to be bullish or bearish. It can be chop, right? But let it get back to zones that operate in the 68% probability, which is what it's done all year up until about the 4th of April, with one, maybe two exceptions, individual candles. And when you watch that video, you'll see, oh my gosh, yes, I'm not going insane. This is something very unusual. Now, the good news is yesterday was the first step of things starting to contract, whether that be price moving to first and second standard deviations, or whether that be volatility. Yesterday was a first day, and we had one of these before. We had something like this on the 8th. But yesterday was a first day after a prolonged period now of increased volatility that there's a little bit more normalcy coming in. Yeah, I know it's early. It's only 4 minutes after 9, but you can also see here a little bit more normalcy coming in. And this is good news. This is what we're waiting for. And, if you're wondering, Rag, at what point does it make sense to tap the brakes and say, oh my gosh, I need to wait for normalcy? I would say, if you're thinking about it, the process really begins, hey, I need to really consider whether I need to go pencils down for a little while. I'd say Friday and Monday are when the question really gets asked. You really start to ask yourself, what do I need to see to persist in this environment? And do I really need to think long and hard about just pausing? I'm not saying stopping. I'm not saying closing all trades. I'm just saying pausing new entries. And that really became the question Friday, Monday. So if Tuesday, Wednesday start to say, nope, we've got it out of our system, this is absolutely what we're looking for. So we'll continue to monitor this. All right. And If you've been here a while, hey there, Paul. If you've been here a while at Charts and Coffee, you probably are already familiar with a lot of the terminology and the process that I use. And you'll see, yeah, Rog, necessarily, I may not be necessarily up to speed on what's happening. But here's what's cool, Paul. This is where the tools matter. This is where the tools say, Rock, I've been watching you a while. What am I looking at? This is where the tools matter. Take a look at the yellow. Take a look at the red, right? Do you see, Paul? If you've been with me a while, right, for about a month, you can see how different that is. And the reason I can say that with such confidence is I already have these gauges, call them indicators, call them whatever you want. I like to call them secret squiggles sometimes, but they are calculating what's happening in terms of price, participation, size, but volatility. Those are all the things that are happening. And so when I look at that yellow candle, my tools tell me, oh, this is markedly different than anything we've seen this year. Then we get a red candle. We haven't even had one of these on the daily time frame of the S&P all year. Then I get two. Now I have four. That's where your tools visually, and I love color coding. Because it's traffic light simple. Isn't it amazing we can travel the world and a traffic light's pretty much a traffic light. A stop sign's pretty much a stop sign. I love that sort of universal, very intuitive thing where someone can look at a chart, say, Rob, just kind of cue me into what each color means, and then boom, you're off. And so when you're off to the races, right? And so now yellow is neutral. Red is bearish. And so the tools are telling me this is markedly different than what we had before. Now, what about the NASDAQ? Let's say I do the same thing with the NASDAQ. Let's put these top tier pro system tools to work. What have we seen all year? And you notice I've anchored us to basically the last couple of trading days of December on this view. So January 4, a little bit of neutral. January 5, a little bit of neutral, right? And by the way, we're at the mean reversion. The candles before it were green. No reason to get bearish. There's no red. And then off to the races. All-time highs, by the way. If I'm focusing on the green candles, I know I'm going to be bullish. If I'm focusing on the green structure, I know I'm going to be bullish, looking for those setups. And all-time highs, a whole bunch of them came in time after time after time. Then what happened? Okay, yellow candle. And you might say, you know what? I saw one of those on June 4, and here we are in April 4. By the way, that's how many months it took to plot something that said, hey, not as bullish as before, not bearish, but not as bullish as before. Then another one. Okay, that's a little different. Look at the size of these candles compared to the yellow ones. All right. Then another one. Then another one. And then now I feel like DJ Khaled and another one. Okay. So they're finally on the 15th, right? There on the 15th, we've got the first red. And that's where things start to get a little different, very different than what we've seen before. And that's where we are right now. The overall uptrend is broken, but this is where you might say, Rog, is this a downtrend? It's not. And let's go take a look at another part of this chart right down here. So see that gray? That's a non-trending environment. Gray trend, no trend. This tells me there's a little bit of bearish momentum. Well, that makes sense because that's going to sync up with the fact that I've got the first set of a couple red candles. Now, if I get bearish sentiment, but really without red candles, that's a mismatch and I'm not going to concern myself. But here, at least I want to pay attention. At least I want to respect the fact that for the first time this year, after 3 months, it took 3 months for the bears to even have any kind of traction. 3 candles. That's it. So when folks ask me, Rog, is this bearish? Not on a daily time frame. Now, if we look at an hourly time frame, if we look at a 5-minute time frame, those psychologies can rotate. They can cycle around pretty quickly. But on the much more important, much more psychologically significant, much more well watched, right? Why is this psychologically significant? More traders are looking at their position in relation to the previous close. So this is really the most important view in terms of understanding the broadest group of opinion, the broadest class, of active traders or active investors, etc. All right. By the way, I do want to remind everybody our class is still going on. If you haven't checked it out, if you want to get your hands on these tools, that's the way to get it, toptierproclass.com. All right. Question here. NET. Sure. Sandu. All right, looking at NET. Earnings were on May 2. I love that they're way far out. I don't love that NET is not in a trend. So I would pass because what I want to focus on are symbols that have the most likely, right, the most probability for following through. And we've been in a chop on and off for most of the year. So this isn't necessarily something I would consider strong. It's had moments of strength around earnings. And I know a lot of traders are thinking, hey, Rog, could we end up with something like this again? I wouldn't rule it out. I wouldn't rule it out. But I wouldn't rule out a move to the upside. So what I would say is one of the things that we talked about in the class, which is a very specific setup using the automated support and resistance. And I'll tell you, right now it's neutral. It is above, as we like to call it, the equator. So that would be something maybe it could get a boost with earnings, but I don't have a trend here to really focus on. Maybe an oversold Darvis support level. All right. Juan asks, does the separation between the yellow and the gray in the daily price movement range mean anything? Yes, Juan, it does. It's indicative of, well, here's the thing. The space around it is just indicative of volatility. But the main thing we want to remember about, not so much the space between, but what are the yellow and gray telling us? So yellow is, let's go on over here. Yellow is resistance, or the gold. The gold is resistance. The gray is support. The space between them is just where price action is able to move on a regular basis. What's more important about the gold and the gray is when they either touch or when they overlap. When they touch or overlap, now that's an instant read by design of the daily price movement ranges to indicate that we've got higher than 68% probability. All right, higher than 68% probability price action. We're in that rare air. We're in that 1/3 of unusual action. So watch when they cross or watch when they touch. That's indicative of, hey, we've exceeded that 68%. All right, next up, treasuries. Sure, we can take a look at ZN. Sure. All right, if we take a look at the 10-year, whether you look at TNX or ZN, I look at the futures contract. Of course, remember the yield is inverse to the underlying futures contract, or by the way, the ETF. So bonds have gone decidedly bearish. They held their own for quite some time, but they've gone decidedly bearish, not because they don't expect a Fed rate move, but it's just taking too darn long. And they're starting to claw back a lot of the gains that, meaning lower yields and a higher move in the 10-year, we're starting to claw that back as the Federal Reserve has been unclear. They've been very, very coy about inflation. So many Fed members are putting in their 2 cents, and there's been a lot of confusion, conflicting opinion. The only person who matters is Powell, but yet we have so many other Fed members. So the longer it takes for the actual cuts to get here, bonds are going to say one or two things. That A, it's taking too long and you're going to break the economy. That's why good news is bearish and disappointing data is bullish, by the way. And the red candles tell us it's been, obviously a challenge for bond traders to keep up some of the Fed is going to cut optimism. And you can see that in the candles all year. There's been a steady mix of confusion. When these candles are red and green and yellow, and then they start to trade below the equator, that's going to be a little bit more bearish. I haven't been playing bonds. I don't want to buy them, but at this point, I can't. I don't want to short them, but at this point, I can't buy them. So as far as impacting the market today, look, we're above the previous session close. That's worth keeping an eye on. And then as far as today goes, remember, bonds are already moving, right? So there might be some pre-market action to look at. If you take a look at what's been happening since the European session, the UK session, it's been generally bullish. So I would focus on hourly price movement range buys intraday. And then as far as end of day, unless one of these candles touches the gray or the gold, there's really nothing for me to do. So it's going to be a little bit more intraday action that I would focus on. Make it a day trade. Be nimble about it. It's a tricky environment. All right, FAST. Red candles, no trend above the equator. I would be very cautious about something like this. I think there are, here's what I would say, Panthers. If you're looking at FAST, take a step back and ask, well, what else is in this group? Is this the best example of a trend? And if it is, then, look for a setup. But I would have to say, in the case of FAST, look at other symbols that move in the same niche or in the same sector as it, and then do a relative performance comparison. All right. I forgot what the 6C tells us about the US dollar. It is an inverse look at the US dollar. So if 6C is moving higher, dollar's moving lower, and vice versa. It's an inverse look. The highest correlation of any two symbols in any market is the relationship between the US dollar and the euro. All right. Mike R says, I grabbed Schwab when it dipped into the wave Friday. I used your older layout, but want to see what it looks like on the new layout. There you go. So I don't have the daily price movement ranges running on Schwab at the moment. So if I was looking at the May 17s, yeah, we might, I don't know, we might have to bring this back. The open interest has been a little spotty here and there, but we might have to bring this one back in terms of daily price movement range, because we'll cycle in and out of the list of DPMRs for different symbols based on open interest and beta and all sorts of other things. But yeah, I would say, look, it's definitely something we would focus on the long side. And if you're looking at different reasons to get long, hey, look at the Darvis as well, right? Whether you want to be aggressive with the Darvis or more conservative with the Darvis, go back 2 or 3 recent Darvi, right? Look, go back 2 or 3 boxes and say, hey, where is support? And it's uncanny. So when you get that kind of overlap between, say, a mean reversion like my wave, and then you look at the automated support and resistance of the Darvis, you start putting things together. You start stacking these automated tools. You start stacking the things on your chart. All of a sudden, you'll see, oh, here's a volatility reason. Here's a price-based reason. Here's a mean reversion reason. And do I want to be bullish? Now, I'll tell you, in this environment where Schwab is wobbling a little bit, so right now, we don't have a trend. We've been here before. Continuation is most probable. I agree. Would I buy? That's the only thing to do. I'd likely want to have some daily price movement range confirmation, and maybe I have it turned off for whatever reason. I'll have to look. But as long as we're above the 200, and as long as most of the candles are green, and they're all green since mid-February, yeah, great trade. Great trade, Mike. Sorry. Great trade. That's good stuff. I would also say be careful with financials right now, because we are in that earnings season where financials are getting release after release after release. And one heavily weighted stock can really drag down the group, especially when it's something like JP Morgan. So financials have been struggling, not because of the overall movement higher in Schwab, but because JP Morgan gapped down and is still moving lower. And that's what makes financials a little tricky. So Schwab, Mike, what I would say is mark that high. Mark that resistance on the Darvis high that you have there. And remember that if XLF is moving lower, how much harder Schwab is going to have to work. Here we go. See this, Mike? Look how much harder Schwab is going to have to work. So maybe keep an eye on that 73 area as we're moving higher. All right. And say, hey, if I bought the Darvis or if I bought a dip and I'm at a level now where I could see some resistance, maybe scale out of a third, scale out of a quarter, maybe scale out a half, pay yourself, whatever that means to you, and then move to a break even on that position. So at that point, you can be really ambitious with a T2. And then remember, all you're risking at that point, barring any gaps, is unrealized profit. And that's really where we want to be right now in terms of something like, so well done. Yeah, really nice. Okay, gang. And just like that, our show is up. Thank you as always for being here for Charts and Coffee. I'll see you tomorrow. Same time, same station, gang. Be good to each other.